You lost money today, and yesterday, and every day before that.
Two Bitcoin transactions can look almost identical on chain, but mean completely different things in your records. One move might be you sending Bitcoin from an exchange to your own cold wallet. That is usually a record-keeping event. You still own the coins, you just move custody. Another move might be you spending Bitcoin, selling Bitcoin, or swapping Bitcoin for another asset. That is the danger zone because now you may have disposed of property that changed in value. Same chain, same arrows. Completely different story. That is why the question is not, did Bitcoin move? Bitcoin moves all the time. The better question is, did ownership or economic exposure change? If the answer is yes, you need to slow down, document it, and talk to a qualified professional when it matters. Today we are building the simple mental model. Record-keeping move versus potentially taxable event. Not tax advice, not legal advice. Just the map that keeps you from confusing a wallet transfer with a sale or a sale with a harmless transfer. This is exit velocity. In the last episode, we covered the paper trail, what Bitcoin records you need to keep, why exchange exports are fragile, and why the blockchain does not know your cost basis or intent. This episode answers the next question. Once you have the records, how do you classify the move? Because every Bitcoin holder eventually faces this. You buy on an exchange. You withdraw to cold storage, you send a test transaction, you consolidate wallets, you pay someone, you sell a little, you swap, you donate, you gift, you receive sats, you move coins back to an exchange. Some of those are mostly paperwork. Some of them may create income, gain, loss, or reporting questions. If you treat all of them the same, your records become chaos. Here is the simple rule. Movement is not the same as disposal. Bitcoin moving from one address to another does not automatically mean you sold it. The public ledger sees coins move. Your records explain whether you still own them, whether you paid someone, whether you exchanged them, or whether you simply changed wallets. The IRS treats digital assets as property for U.S. federal tax purposes. That framing matters because property rules care about acquisition, basis, disposition, value, holding period, and gain or loss. Again, this is educational framing, not filing advice. So the question becomes, what actually happened economically? If you bought Bitcoin with dollars and kept it, that is different from selling Bitcoin for dollars. If you moved Bitcoin from your exchange account to your hardware wallet, that is different from sending Bitcoin to a merchant for goods or services. If you move Bitcoin between two wallets you control, that is different from swapping Bitcoin for another asset. The chain may show movement in every case, but your tax and record-keeping question depends on the meaning. That is why your memo field matters. The memo is not decoration. It is the label that says internal transfer, sale, payment, gift, test transaction, or move to cold storage. Without that label, future you has to become a detective. Start with the moves that people often panic about, but should classify carefully. Buying Bitcoin with dollars and holding it is usually not the same as selling. You still need the record, date, amount, price, fees, platform, and basis. But the buy itself is not the same as realizing a gain. Moving Bitcoin from an exchange to your own wallet is usually a custody move. The coins left the exchange and arrive somewhere else you control. That does not magically turn into a sale just because the chain shows a send. Moving Bitcoin between your own wallets is also usually a record-keeping move. Hot wallet to cold wallet. Mobile wallet to hardware wallet. Old wallet to new wallet. Exchange account to self-custody. Self-custody back to the same owner's exchange deposit address. But notice the word usually. Your records still need to prove ownership and intent. If you cannot show that both wallets belong to you, the transaction may look like a payment to someone else. That is why wallet labels matter. Test transactions belong in this category too. A tiny send before the real send is not automatically a separate sale. But if you do not label it, it becomes one more weird little line item later. This is the record-keeping lesson. Non-taxable does not mean undocumented. Non-taxable means you may not owe tax because of that move. Undocumented means you may not be able to explain the move. Those are not the same. Now the danger zone. Selling Bitcoin for dollars is the obvious one. If you bought at one price and sold at another, there may be a gain or loss question. Spending Bitcoin can also create a disposal question. If you use Bitcoin to buy something, you did not only make a payment, you may have disposed of property. That means your records need to know what the Bitcoin was worth when you acquired it and what it was worth when you spent it. Swapping Bitcoin for another digital asset can be another disposal zone. People sometimes think, I never cashed out to dollars, so nothing happened. That is not the right mental model. Trading one asset for another can still matter. Sending Bitcoin to someone else as payment, compensation, settlement, or reimbursement can also need careful classification. Was it a purchase, a payment for services, a gift, a business expense, a personal transfer? The chain cannot answer that. Your records have to. Receiving Bitcoin can create its own questions too. Did you buy it, mine it, earn it, receive it as payment, get it as a gift, win it, receive it through a reward program? Different facts can mean different reporting treatment. This is where I want to be careful. Do not use a YouTube video as your tax advisor. Use this as a warning light. If ownership changed, if you receive value, if you exchange assets, if you spent Bitcoin, or if someone paid you in Bitcoin, slow down and document the event. You do not need to know every rule in the moment. You do need to capture the facts while they are fresh. Here is the practical filter. Question 1. After the move, do I still control the same Bitcoin exposure? If the answer is yes, it may be an internal transfer or custody move. Example, exchange to cold storage. You still own it. The record should say that. If the answer is no, slow down. Maybe you sold it, spent it, swapped it, gifted it, or paid someone. That is not just a wallet movement question anymore. Question 2. Did I receive something in return? Dollars, goods, services, another asset, debt relief, business value, anything. If something came back to you in exchange for Bitcoin, you are in the disposition zone. Question 3. Did someone else receive beneficial ownership? If you sent coins to a merchant, contractor, friend, family member, exchange buyer, or another person, the transaction may no longer be just your internal movement. It needs a label. These 3 questions do not replace professional advice. They tell you whether the event belongs in the simple records bucket or the ask better questions bucket, and that is enough to prevent most chaos. There is one sneaky part people miss: fees. Bitcoin transaction fees can make a simple transfer look more complicated. You may move coins between your own wallets, but some amount is used to pay for transaction services. Under current IRS digital asset FAQ language, own wallet transfers are generally non-taxable except to the extent digital assets are used or withheld to pay transaction service costs. That is a very annoying sentence, but the record-keeping takeaway is simple. Do not ignore fees. Record the fee, record the source, record the reason. If a professional later needs to classify it, the facts are there. This is also why exact amounts matter. If you sent 0.100 BTC and received 0.09945 BTC after fees, do not round it into about 0.1. That difference is part of the record. Fees are not glamorous. They are exactly the kind of detail that makes a future reconciliation either clean or miserable. Let's run the examples. Example 1. You buy $500 of Bitcoin on an exchange and leave it there. Record the buy. Date, amount, dollar value, fees, exchange, basis. Usually this is not the same as a sale. Example 2. You withdraw that Bitcoin to your hardware wallet. Record the transfer. Label both sides. Note the fee. Memo. Move to cold storage, same owner. Usually record keeping, not a sale. Example 3. You sell some Bitcoin back to dollars. Now you need basis, sale date, sale proceeds, fees, holding period, and which lot or method applies. This is the classic gain or loss zone. Example 4. You use Bitcoin to pay a designer. That is not just I sent Bitcoin. It may be payment for services, and you may have disposed of Bitcoin that had a different value than when you acquired it. You need records on both sides. Example 5. You send Bitcoin from one wallet to another wallet you also control, but you fail to label the destination. Future, you now has an unlabeled withdrawal and no proof of context. The event may have been harmless. The documentation is not. That is the theme. The tax result depends on facts. Your records preserve the facts. Here is the system I would use going forward. For every movement, add 5 classification fields to your normal record. 1. Event type. buy, sell, spend, swap, receive, gift, internal transfer, fee, or unknown. 2. Ownership after the event. Still mine, no longer mine, partially mine, or unclear. 3. What came back. Dollars, goods, services, another asset, nothing, or unknown. 4. Fee paid. Amount, currency, platform, and whether it came out of the Bitcoin sent. 5. Evidence. Exchange confirmation, wallet transaction ID, invoice, receipt, email, note, or screenshot. If you do not know the answer, do not guess. Mark it unknown and fix it while the memory is still warm. That one word, unknown, is better than fake certainty. A clean record can say, I need to investigate this. A bad record pretends everything is obvious until tax season proves otherwise. This is what the Holder Toolkit is built to support. Not magic tax filing, not advice, not pretending a spreadsheet replaces a professional. It gives you an owned record so you can answer the basic questions before you ask someone else to help with the complicated ones. The chain will tell you that Bitcoin moved. It will not tell you why. Your exchange may tell you what happened inside its account. It will not label every wallet you control. Your accountant can help interpret the rules. They cannot recover context you never wrote down. So the assignment is simple. Open your Bitcoin records. Add the classification fields. Go through the last 10 Bitcoin movements you made. For each one, ask, do I still own it? Did I receive something? Did someone else receive ownership? What fee was paid? What proof do I have? If you can answer those questions, you are already ahead. Next episode, we go one layer deeper. Once you know a sale or disposal happened, the next question is, which Bitcoin did you sell? The lot you bought first? The lot you bought last? The most expensive lot? That is where cost basis methods come in. This is exit velocity. Own the record. Know the trigger. Think in Bitcoin.